Hi, this is Ron Janish. In the last video, I made a mistake, and I'd like to kind of correct it here. Uh, I started talking about Tom's favorite pattern and Tom French being somebody who lived down the street from Alan Andrews, and he published and wrote the first article ever published I've ever seen on the median line back in Stocks and Commodities magazine. Now there's just tons of them all over the place that I wrote. Uh, anyway, good old Tom, who lives down in Florida, came to my seminar in the New York area. Here's the mistake, by the way. I didn't tell you the whole story about Tom. So I'm going to tell you now. And so Tom told the group that, him being an engineer, he was really kind of picky on what he uses. And this is a guy who makes his living trading the markets. And he studied Andrew's material, and he looked for something that was incredibly reliable, that occurred on an intraday basis and regularly, and was useful for the S&P. Okay. And what he found was there was a certain kind of pattern, and what we do is we call this pattern Tom's favorite pattern. And in the course that I teach, there is one segment, and it's in a video, that shows a intraday time frame method of using Tom's favorite pattern. And Tom's favorite pattern is something that a gentleman by the name of Welles Wilder, okay, taught how to use it in a course for about $5,000. Now this was in the 70s when Andrews was selling his course for $1,500. Okay, so Welles Wilder gave one seminar on this particular pattern and how to use it. Well, we're going to use it and I'm going to show you some aspects related to it that are very relevant right now. Okay. So what we did here was we found back in, look at the date here, October 8th, 2007. Okay, this particular bar. Okay, so the high here in this area here, October 2007, we had what we call Tom's favorite pattern on the weekly SPY chart, S&P 500. Okay, well-known stock market indicator. Now notice that when we drew the lines later on as price went down, we used that particular pattern area as a starting point for finding the bottom. Okay, now we can look at that and look at it with perfect 20/20 hindsight and pat ourselves on the back. Okay, now look at this. Here comes the fun part. Moving forward, this is where the market's gone up to. Okay, this was a few weeks ago. Look at the date, July 22, 2019. So, once again here, you have the same pattern, which affords you the ability to draw the same lines. Okay? So in here, you have this pattern. And if you look over here, these other places, you don't have this pattern. You don't have Tom's pattern. Let's take a look at other tops. Do you have Tom's pattern? Just over here you have Tom's pattern. I can look at, if you take the course, you'd be able to recognize it real easily. And we're here, and notice that price kind of went sideways for a while. It did a nice correction. This was back 2015. Oh, okay, and then went all the way down to here. Low in 2016, and then we had the election, and up we go. Was that 2018? And yeah, well, we did have the election later on. Okay, so this is what we have right now. This is important because it is this type of a pattern that signals that a significant counter move is to come. And we can see here with the high in this area here. Let's see, did you have the pattern here? So you had the pattern over here, and then you went sideways, and then up you went again. So it signals that when you have the pattern, you will at the very least get a significant counter move. And this, it'll either take a lot of time or a lot of price. Okay, so we're coming into a time period when we're going to get a down move that will take a lot of time or a lot of price. And you can do this, and you can draw your reference lines, your ladder. Okay, to help you see where you're going to get support and resistance as the market goes down. All right. Now, does this only apply to the S&P? I don't think so. Okay. You look closely here. I can remove some of these lines here. Kind of a waste. Okay. Well, first of all, let's go back here in time. And this was high in 2007. Here's your low. Okay, so let's get rid of all this. Well, let's just see what happened along the way. Okay, so remember these are weekly charts, right? Let's take these away. These away. Okay. Okay, so right in here, if we look in here, we can see that we have the pattern again. And so what you're going to do to help you find the support and resistance points as price heads down is do something like this. Okay? Now, those of you that are in the Andrews Expanded course and also understand the techniques of the Babson reversal line know that the high here in the Dow and in the S&P 500 was found using the Babson reversal line technique, BRL, right? So anyway, we're looking for this to go down, okay? Now notice that you also have the pattern here. Let's take a look. I don't know if you had the pattern in 2007. Let's take a look. No, not really. Well, let's try something else. See if this works. No, it really doesn't. Oh, maybe I'm not doing it right. Let's try this. No. Let's try something else. That works. Okay. So let's take a look and see how this applied to the future. Holy smokes. So as you can see, the Qs really outdid this. Let's play with this a little bit. Well, now there's a product we developed a long time ago called Precision Trader. And what was nice about it was this kind of drawing would happen automatically. And it was a lot more exact than what I'm doing here. Yeah, this ain't doing it. Anyway, so what you have going on here is you have a pattern which indicates that your next support target is down here. Okay. And that there should be a considerable power move to the downside. So, if you're prepared for this, that's no big deal, you know. Okay. So, anyway, Ron Janisch here with AndrewsCourse.com signing off.